In today's video, we're going to discuss a topic that I see a lot of mistakes and misconceptions around, and that's the impact of portfolio return on your Social Security filing decision. Now, hopefully this video helps to steer you in the right direction. Let's get into it. When we talk about filing for Social Security and making the best financial decision, there's a lot of variables that can matter and weigh into our decision-making process. After testing the effects of a lot of these variables, I've come to realize that the most important variable that feeds into finding your best filing decision is first and foremost, number one, longevity. If we project out that you're only going to live to age 70, none of the other variables really matter. You should always file at 62. If you are going to live to age 100, almost none of the other variables matter here as well. You should probably file at age 70. But the second most important variable outside of special cases is portfolio return. And here's why this matters. Let's say we are looking at a couple with full retirement age benefits shown on the screen. This couple is 62. If we look at them using a split strategy, like the wife filing at age 67 and the husband filing at age 70, you can see that for the first 8 years of their retirement, they're going to have to spend about $256,000 more from their portfolio in order to delay Social Security. Now, behaviorally, this is incredibly difficult, even if it is the right quantitative decision. Some of you might be thinking, in this context, who the heck would ever delay taking their Social Security benefit? Well, if we step forward and look at the next 20-some years of their retirement, this is why it might make sense. By delaying Social Security, a bigger benefit is earned. The bigger benefit for a longer period of time means this couple will need to withdraw approximately $525,000 less from their portfolio. So they are effectively spending $1 today to save $2 tomorrow. Now, shown in this context, delaying Social Security can seem much more reasonable. But is it really? How do we make heads or tails of whether this trade is worth it? Well, we need to know what the time value of money is today versus later in retirement. The time value of our money is based on your portfolio return. If our portfolio is growing at a high enough growth rate, we'd rather keep more invested in our portfolio to beget more of that growth. But how should we think about or use portfolio return as part of our Social Security decision-making process? Well, let's walk through some examples and see if we can shed some light on this question. We're going to use John and Sally as our baseline plan here. For the sake of having all the options of filing between 62 and 70, we're going to say they turn 62 at the start of next year, and they're the same age for simplicity's sake here. I said earlier that life expectancy is a huge variable when running a break-even calculation. In this example, we're going to use age 85 for John and 88 for Sally. To take a small tangent here, some of you might look at this and go, that's crazy. Life expectancy is around age 78 here in the US. But this is a misguided way to look at life expectancy because that 78 number is measured from birth. As you age, you outlive the risk pool that pulls down the average, and so your life expectancy rises. In fact, we can go directly to the Social Security website and find a more accurate life expectancy. For John, based on his birth date, his estimated life expectancy from right now is a bit less than 84. I'm using closer to his full retirement age life expectancy, as John and Sally have about $2 million in retirement assets, and larger wealth is closely correlated to longer life expectancy. And we're going to assume this couple is also in better than average health here as well. Sally's life expectancy today would be a little over age 86, which again, we're using closer to their full retirement age life expectancy for the same reasons I just discussed. Now, as our first base case, we're going to assume John and Sally's portfolio return is 0%. Now, this is unrealistic as even investing in cash should earn a positive return, but we're using this as a base case to compare to as we raise that portfolio return. Now, what our Social Security software is going to do is it's going to take all relevant assumptions like this couple's benefit amounts, life expectancy, inflation rate, portfolio return, and more. And then it's going to run every potential month each person in this couple could potentially file and find the best strategy. Given this 0% portfolio return, we would find the best strategy would be to delay both filing times to age 70. Both spouses would be maximizing their Social Security benefits under this strategy. And although this would cost them with bigger withdrawals earlier in retirement, the math shows they would more than make up for that earlier cost with the higher benefit. Now, we're going to continually show these two graphs as we compare portfolio returns. On the right-hand side, we have the break-even compared to filing as early as possible, age 62. Filing early is shown in red. We see the break-even point here is when they reach age 77, which we expect them to exceed by a few years based on that longevity assumption. There would be nearly $500,000 in extra benefits given these assumptions. On the left-hand side of the screen, we have a heat map that shows John's potential passing away on the x-axis and Sally's on the y-axis. This will allow us to look at variations around life expectancy at a quick glance and see which strategy is best. As we can see, the majority of the area on this graph shows delaying to be the best option here. Now, just as a quick aside, this heat map shows only 3 strategies for simplicity's sake. In reality, a person can file for Social Security in any month between 62 and 70. Given this, there are significant combinations of filing strategies. The most accurate way to look at this heat map would be shading every intersection in with the best strategy. Here, every color would signify a different strategy, but for the sake of this video, this is getting a little bit too much into the weeds. So as I said, using a 0% portfolio return is too conservative in my opinion. But what portfolio return should we use? Well, this is going to be somewhat dependent on how you are invested. On the screen, I have a few sample portfolios from 100% stock to 100% bond. And we are looking at all of this data back to 1928. Now I'm showing after inflation returns, otherwise known as real returns. Because Social Security is an inflation-adjusted asset, we can basically focus on real returns in looking at the break-even. Given these 20-year rolling periods, we can see that in the worst 20-year runs, nearly every portfolio does worse than inflation outside of that 100% stock portfolio. Average 20-year returns give us a little bit more of a middle-of-the-road assumption to work with. And then on the right-hand column, I show the percent of 20-year scenarios where real returns were less than 3%. Now, given this data, what portfolio return should we use in finding our Social Security break-even? Well, it's not immediately obvious. Some say we should use the average or median returns. In some contexts, this is fine, but I think it would be overly aggressive. Consider the assets we are comparing. Social Security is meant to be an incredibly safe asset, guaranteed outside of government intervention. A portfolio of stocks and bonds is a risk-based portfolio where we expect a big dispersion of returns. Keep in mind, in most of retirement, we do not just compare average or median returns and make decisions based off that comparison. Otherwise, we would all hold 100% stocks and no one would hold bonds or cash, as median returns of stocks dwarf other asset classes. We would also spend a lot more from our portfolio if we just assumed median market returns. We focus much more on risk in retirement planning. In fact, in most areas of retirement planning, we focus more on the less than ideal situations than we do the median or best trials. Also, how are you thinking about or using Social Security inside of your plan? Are you using your filing strategy as a sort of investment to try to choose your best option based on unknown assumptions? Or are you using Social Security as insurance in case market returns aren't as robust or you live longer than expected? The latter may cause us to use a more conservative portfolio return. Then finally, if we delay Social Security, what are we going to consume first in delaying? If we're going to take from our portfolio equally, then we could use portfolio expectations around the given portfolio that we hold. But what about if you consume safety first? This is quite common and means we may want to be closer to comparing Social Security to safe asset returns like the 100% bond route. There isn't exactly a right answer here in analyzing this question, but I would recommend most families use a portfolio return somewhere between the worst and average case scenarios based on their portfolio. In our next comparison scenario, we're going to look at portfolio returns as equaling inflation. This is more or less what we would see in the worst 20-year period as shown in the previous table. This may be surprising to some, but we see the best strategy once again being that both retirees delay their Social Security strategy to age 70. But here we see there's some variation in the break-even and benefit that we gain from this strategy. Here we see the break-even move back a couple of years to age 80. Additionally, we see the benefit from delaying drop from over $450,000 to slightly less than $200,000. When we look at the heat map, we see the amount of space delaying makes sense has now shrunk. If either John or Sally passes away a few years earlier, then a split strategy where John delays, but Sally starts taking at age 67 rather than 70 starts to become the best strategy. Interesting, but let's keep going. Let's now raise the portfolio return to 3% higher than inflation. Keep in mind that a balanced portfolio does worse than this roughly 25 to 30% of the time. In this context, we see the best strategy is updated to Sally filing for her Social Security benefit at age 68 and John delaying his benefit 1 year later to 69. Even at a 3% after inflation rate, we still see delaying quite a bit still makes some sense. What will change relative to the other situations is how much benefit we gain from that delayed strategy. Because our portfolio return has grown, the benefit we gain from delaying shrinks and is now only $40,000 at the time of expected death. The break-even has moved back to age 83 now, And as we look at the heat map, we see filing at 62 has grown and started taking up more space on this heat map. In a scenario where one spouse lives longer and the other passes away sooner, we start to see a split strategy makes more sense, which, well, makes sense. When one spouse dies, the other spouse inherits the higher of the two benefits. So one spouse passing away prematurely and the other spouse living a long life means you should have a split strategy. Then finally, we're going to make a big jump and assume our portfolio return is 7% over inflation. Now, this would be a much more aggressive portfolio assumption, but there may be some of you that are willing to take more of a riskier approach to managing Social Security. Given this higher portfolio return, we see that filing at 62 makes the most sense for both spouses. Given our life expectancy assumptions, we would see that this couple never sees a break even. They would need to live to around 100 for the delaying strategy to make any sense. You can further confirm this with the heat map, as even if you look at both couples living to 95, they would still be better off filing at 62 because of that big portfolio return. But there's more to the story here than we've just covered. The test that we've run thus far has been using something called the straight line method for portfolio returns. This means that if we're using a 5% portfolio return, it's going to assume we earn 5% each and every year with no variation. But this isn't how investing works. Let me give you an example. So we just showed that a 7% return after inflation should mean that filing by 62 by far makes the most sense. Well, here is a 100% stock portfolio that averaged 7.2% after inflation from 1970 through 1997. Despite this, we see a split strategy of taking Social Security at 70 and 67 actually wins out by over $500,000. Now, this completely goes against what we just showed. So what's happening here? Well, anytime you have a portfolio with volatility and you are withdrawing from that portfolio, there is a sequence of return risk that enters the picture. If your portfolio drops in value and you withdraw from that portfolio, you are furthering that drawdown, making it more difficult to recover. Now, sequence of return risk can play out in all cases, both at taking Social Security at 62 as well as delayed strategies, but is a greater risk in taking your benefit at 62. And the main reason here is because you ultimately have a smaller Social Security benefit or guaranteed income stream for a longer period of time. Because of this, I would urge most to discount the portfolio return by 1, maybe even 2% to deal with sequence return risk. In addition, there's a lot of data to show that most investors don't keep pace with index returns over time. This is an ongoing study by Dalbar that compares investor returns to the comparable index. Over the last 30 years, the average stock investor has underperformed the index by over 2% per year. Before, I was showing returns based off index data. But if you consistently underperform index returns, this would be another reason to lower that portfolio return. Now, I hope this presentation today helped with your understanding around a topic as complex as Social Security. Let me know if you have any comments or ideas to add to this analysis down below in the comments. And if you're wanting to learn a little bit more around topics like whether Social Security will be around for the remainder of your retirement due to solvency concerns, or you want to know what the real return on investment is of the tax dollars you paid into Social Security, click on these 2 videos right here to learn more. And always remember, you don't need more money, you need a better plan. We look forward to seeing you in the next video.